Rocker asking, how much will lumber cost in 2023? I don't know, but it'll probably be 350. Financial asking, bull or bear, who is fuck? Me personally, I am both when I need to be. As for who is fuck, everybody. Because thanks to the zero reserve loophole, there may very well be a run on banks and not enough cash to fulfill it. Federal ad asking, when did Visual Mod become sentient? I think last year when it was connected to OpenAI. You'd have to ask ZJZ on that one. Planet of Power asking, what is a better play, in the money or out the money calls or puts? Shortest expiry or longer term expiry options? So there's no best, at least among those dimensions, there's no best play. You have to consider what your expectation of the underlying stock is and compare that expectation to what the market is expecting. So sometimes it's good to sell a deep in the money call as a buy right because the market is over indexing dramatically on implied volatility. Sometimes you think the stock price will be more bearish than the market is expecting, so you would want to buy a put contract. Or you think the market is more bullish, or the stock will be more bullish than the market is expecting, so you'd buy a call contract. Or you think there's no way this earnings report will only be plus or minus 3% as the market is expecting. It'll probably be greater, so you could buy a strangle. And there are all sorts of combinations of buying and selling options contracts that allow you to realize your expectation of the stock price as it relates to what the market is expecting. Oh boy. Okay, so Public Enemies asking, pretty please recommend me useful books or articles on options and or quant trading. So if you've already read Options, Futures, and Other Derivatives by John Hull, the next thing I would suggest you read is the original Black-Scholes paper. If you Google around, you can find the PDF hosted at Princeton. So that would, and then once you've read and like understood the Black-Scholes paper, pretty much any other academic paper about options volatility and risk pricing and risk management or binomial option pricing models will be your best bet. My problem with using textbooks for anything but the most basic stuff is that by the time a textbook gets published, the information is maybe 1 to 2 years old. And that may not be useful if you're trying to find an edge in the options markets. Beautiful Cookie asking, what's the point in doing an option worth more than $400? The point is that some people are willing to pay even more for that option after the price of the underlying stock changes. So the individual price of the option is largely irrelevant to me, with the exception of for risk management. I focus more on can I buy low and sell higher? That's really it. The most expensive options contract I've bought was something like $120 premium. So, and I was lucky to get out of that at break even, but still, it's definitely possible to trade at those really, really high premium prices. Trade Titan asking, how do I calculate the timing of entry into an option? The exit, I assume, would be determined by my risk percentage on the losing side and percent profit on the other. Well, that's one way to do it, of course. As for timing the entry on the option, the way I do it is I look at what the market is currently pricing in, plus or minus whatever fudge factor the sell side usually has because of the way cash secured puts would work for them or the way selling puts works. And then I'd slightly underbid the market because the underlying price jiggles enough by some factor minute to minute, which would allow me to buy or to enter at a lower price than most others who may be in the same position have. So it's not so much timing as it is finding a price that I'm willing to pay and letting the market come to my price. That does mean, however, occasionally I don't always get filled on my trades to the amount that I want. So I'll only get a portion of my orders filled. And there are other instances where I completely missed the opportunity because I was too aggressive in discounting the price. and both of which happen every time I trade. So it's more a matter of making sure that I have a positive expectancy in the trades, meaning if I were to keep trading like this in perpetuity, I should expect to make a profit after commissions, fees, spread, etc. And then when I'm exiting, for the most part, I try to sell half on a double and then let exit the remaining at my discretion. So you can use fixed percentages too if you like. It depends entirely on what your expectation for the underlying price movement is. Started Stocks is asking what's with the AAL, I think that's American Airlines, put volume for January 2022. Tremendous open interest. Never seen before. What could be the factors? So I assume you meant January 2023. And the only real explanation I can think of is someone's hedging their position. There's no other. Well, I'm sure there are other plenty good explanations, but for me, that's the simplest, which makes most sense. Anon 43850 asking, will selling CCs covered calls be a good idea in 2023? It's possible. Just keep in mind, however, that you'll start losing money on a sold secured covered call if the price of the stock falls below the price that you acquired the stock minus the premium that you're earning for the covered call. So covered calls generally are good if you are slightly bullish to flat on a stock. Excuse me, deep in the money covered calls are good if you're slightly bullish to flat on the stock. How is Emu Warrior taken asking, how do spreads work and how do Gamma and other weird Greeks and Turks impact the two legs of a spread? So a spread, the simplest spread is basically long one option contract and short another option contract on the same ticker, but for a different strike, a different expiration, or sometimes both. And each option contract has some value of Greek to it. So the long leg could be delta 50, let's say, and the short leg might be delta 30. So you have a net delta 20 on a spread, on this two-leg option spread, assuming the expiration dates are the same. When the expiration dates are different, things get a little wonky just because now you have to add time as a factor. It's not quite the linear relationship that you'd otherwise expect. And the same can be applied to Vega, Gamma, and Theta. Berlin Wall Glory Hole. That's a really thick glory hole. Asking, with the JPM collar, the JP Morgan collar expiring today, where do you see them placing next quarters? Hard to say. My suspicion, based off an Elon Musk tweet, for context, Elon Musk tweeted that he met some really smart financial guys the past week, and they said they were short SPY. Now it just so happened the week prior was the World Cup, where a whole bunch of hedge fund managers and Musk and other like titans of industry and finance were congregating. So I imagine maybe Ken Griffin and Steve Cohen and that type of crowd met with Musk, and it stands to reason that J.P. Morgan will probably be biasing next quarter's collar for more down. But I don't work on their desk, so I don't know for sure. Dry Job asking, I think it's time to buy puts on Caterpillar based purely on technicals. So that's ticker CAT, C-A-T, Charlie Alpha Tango. 200 moving average is 174. Okay, makes sense. So if we look at the chart for Caterpillar, I'll put the link in the comments for Dry Job's post. If we look at the chart for Caterpillar on my website, it appears that, let's see, with the exception of the last roughly 3 months, whenever the price touches delta neutral, from above, so falls down toward delta neutral, it's more likely to come back up. But that only stands true from October 20 to present. Prior to that, let's say June 9 to October 20, the reverse is true. Whenever the price came up to delta neutral, Caterpillar stock price went back down. And if your thesis is that, let's see, you think it's time to buy puts, okay. So for me, the price of Caterpillar is pretty much right between delta neutral and gamma max. So at least for now, it appears, based on how it reacted how the stock price reacted in the past, this price of Caterpillar could go either way. I would start looking at puts on Caterpillar when the price approaches 252, only because the odds of puts becoming profitable is much higher versus just losing money to theta decay. But that's my opinion. Zealous Ideal Ad asking what's going on with UVXY. Dying for a reverse split, banana. I don't know the banana part, but UVXY, for those who don't know, is the UltraVix short-term futures ETF, and typically the ETF is realized using derivatives, and derivatives have a theta component. So while there is leverage involved, it also means that the price will decay into basically nothing. Whether or not there will be a reverse split is unclear. That depends on what the bylaws of the ETF state. Now, Ryler is asking, is negative theta good? It can be. So when you buy an options contract, think of theta as the rent you pay reflected in the decreasing value of the options contract in order to keep the position open and realize any potential gains thanks to the price moving up, which is delta, the price moving up really fast, which is gamma, the implied volatility moving up, which is vega, and time going backwards, which is theta, which would be positive theta for a long options contract. If you were short that same options contract, negative theta is your friend, because when you're short the contract and you have negative theta, you end up with positive dollar gains, so long as the price of the underlying stock does not move too far from the strike price, or does not move, how do I put this, the distance between the price and the strike price of the stock and the options contract respectively does not change dramatically over time. That's when theta is your friend. Okay, let's see. Legitimate Style asking, will these be options only or include some Forex? You're welcome to ask questions on Forex, but recognize that I know options better than I know Forex. So I can't necessarily give the same detail in Forex as I can in options. MSI asking, what is my professional academic background? I have a degree in finance that I got in 3 years. I used to work on Wall Street on their equity derivatives desk. And that's really all there is to it. I do not trade full-time, mainly because I do other things and have other more passive investments that are more profitable for the amount of capital I have deployed. That may change if the recession really is this bad and the startup industry gets really beaten down. So Sabotage is asking, when is the right time for a strangle and when is the time for a straddle? Now, a strangle, for those who don't know, is you buy a put and you buy a call option at two different strike prices, typically for the same expiration. And what happened, you turn a profit on that strangle if the price is farther than either strike price plus or minus the sum of the premium. So let's say I spent $5 per share to enter a strangle for a hypothetical strangle of $10 and $15 strikes. I would break even on that strangle at $5 a share because $10 lower strike minus the $5 in premium, or at $20 a share, the $15 strike plus the $5 premium in this hypothetical strength. A straddle is buying a call and buying a put contract for the same expiration for the same strike price. That usually means one of them is going to be in the money. And the math still stays the same. But because it's the same strike price, the distance between, or the window for profitability, is typically narrower for the same amount of premium. Mitzheimer's asking regarding butterflies, good play during consolidation. Yes, if you're absolutely certain the price will stay between the two strikes, or you just make a really wide butterfly with a low premium, you can make money there. Moo Moo Yum Yum asking 17 black or 32 red. 00 all the way. Unix Enjoyer asking my current outlook on Tesla puts. Do I think it's too late, or do I see it flirting with below $100 a share in Q1? So if we go to my website and we put in Tesla, I'm seeing gamma. That's not right. Tesla. I'm seeing gamma max for Tesla at 198.33. So that's the price at or near which I would start considering buying puts. Delta neutral is at 134.24. And the current price, at least as of yesterday's close, was 121.82. Now, if you look at Tesla's chart, and I'll put the links in the comments so you can follow along. One moment. Butterfly, Tesla, go. So the links in the comments as a response to Unix Enjoyer 305. If you look at Tesla's chart post-split, generally speaking, whenever the price approaches delta neutral from below, so increases toward delta neutral, it comes back down away from delta neutral. Doubly so if delta neutral and gamma max are very close to the same price. So we see that Tesla is coming back up toward delta neutral, and it may very well move sideways for the next week, during which time gamma max comes back down, at which point maybe it may be worth buying some short-term or medium-term put options against Tesla. It's unclear if this will happen within Q1. There are some other factors from the Fed, other event type data that will happen, another bomb cyclone, for example, or a winter storm, which could accelerate or decelerate this projection. Slot Spoiler asking, do I personally buy in the money or out the money more frequently? When I'm long options, it's mostly out the money. If I'm short options, it's probably a 40-60 mix between in the money and out the money. Introspecting Sloth asking, how do I calculate a fair premium price for an option? So what I think is fair versus what the option seller thinks is fair doesn't always agree, and that's okay. It just means that no trade will happen. And generally speaking, from my knowledge of how institutional equity derivatives desks work, I know what sort of fudge factor they're putting into their pricing, and I try to make sure I'm putting my entry price just below that fudge factor, and also making sure that the Greeks derived from the implied volatility, the price, expiration, etc., line up with between my expected entry price and the current market price as it relates to the underlying stock. And I have a whole lot of tools that do this for me, so I'm able to get a sense of, for lack of a better term, get a reality check to make sure the price I'm asking for is something that the market agrees with. Doesn't necessarily be fair or reasonable, just something that it's a price where someone is willing to sell if I'm willing to sell to me so that I can buy, or someone who's willing to buy is willing to buy from me. The Shadow asking, will what not stock be going anywhere stock-wise? Could you please rephrase? I don't really know what you mean. OnlyBit asking, how would I play the run on the banks and how can I tell if it's actually going to happen? Well, the short answer is there's no way to play the run on the banks because, in theory, the FDIC insures all balances up to $250,000, or maybe $500,000 now if you have certain account types. So unless you have more than that much in cash in one bank account, you don't really have to worry. It will become problematic only because it creates a liquidity crunch. So typically, before, let's say, 2004, the way a bank made money is on the spread. They would receive deposits. They would then lend out and pay, let's say, 1% interest on those deposits. They would then take those deposits and lend them out as a mortgage for 2%, and then keep the 1% spread as their revenue to fund bank operations and whatnot. Eventually, the Fed introduced something called fractional reserves. So in order for a bank to lend out, let's say, $1 billion worth of mortgages, they only need maybe $100 million in deposits. Does that make sense? So eventually this fractional reserve, I believe, is zero. So now a bank can theoretically lend out $1 billion and not require any deposits and collateral. And that introduction of relatively cheap money and incentives for the banks to lend it out so they can make their spread may cause introduce a lot of credit and leverage into the market, which will eventually need unwinding. So if you can somehow play the unwinding of that massive credit line that's been extended from all banks, that's probably how you'd be able to profit from this news or this event. As for how you can tell it's happening, the best way is to look for a major creditor that defaults or otherwise can't pay back the loan. Because then whoever extended the credit, the lender, will be on the hook. And if they don't have the capital reserves to pay it off, they have to borrow from someone else. And if no one else is willing to lend, they have to sell assets to pay off the debt or write off the debt. So you can see how this can very quickly snowball and cascade into a catastrophe. It's unclear to what extent this is as systemic as 2008 was, but to say the risk is zero is a little naive. Boozy asking, am I changing my approach as we move into 2023 and the looming recession? A little bit. So for the last roughly quarter, I've been selling cash secured puts on SQQQ and on Yang, mainly because I anticipate some sort of recession coming in, and SQQQ, as recession fears were high over the past quarter, SQQQ premiums were especially juicy, coming in on an annualized, I want to say it was like 170%. That is to say, if I only sold cash secured puts against SQQQ and never got assigned, I would have made 170% of my capital at risk. So when that recession hits, I'll shift from. I don't expect to catch the initial downward movement, but I should be able to buy SQQQ calls as the IV is going up, and that's when I expect to make a good chunk of money. And then same for Yang. I did not expect China to open up this quickly this soon, but it's clear that when they do, COVID cases rise. I was expecting China to open up more broadly ahead of Chinese New Year so people could go home to their families, which is Chinese tradition. And that whole domestic travel and mixing that comes of it would cause the COVID cases to increase and force another lockdown. But Christmas may come early for me on Yang. We'll find out. Ghost 1969 asking, am I still bearish on Home Depot or has my sentiment changed? My sentiment has not changed on Home Depot. Thanks to some friendly information that we received, Home Depot missed their Black Friday sales expectations by 20% for 15 different stores across the US, with the exception of Hawaii. Now, what this means is I entered a small position, about half of the capital I would have committed to this trade, on the chance that Home Depot announces these disappointing Q4 holiday sales before the earnings announcement. but it appears, while there's still a chance it can happen, the odds of it happening are decreasing. I will enter the remaining half of the capital closer to earnings on the once I can review the expected revenue and EPS for the quarter. So because Home Depot in-store sales were lower than expected, lower than the internal projections expected, it does mean that the store managers aren't getting their bonuses this year. So slight knock against them. But more importantly, it could also mean a sharp downward move for Home Depot over earnings. And that's my current sentiment on Home Depot. In order for this to change, Home Depot would need to have huge sales from one of their suppliers, if there's a supplier that reports prior to Home Depot. So I think Scott's, the company behind Miracle Grow, if they announce like 50% increased revenue year over year for the same quarter, I'd have to revisit the Home Depot thesis, because that implies that Home Depot's sales of Scott's went up higher than the drop in sales relative to projections at Home Depot. So I know I said Home Depot a lot of times. Hopefully that all still made sense. No Taste asking, are there any types of misreads or miscalculations that I would say are fairly common, and how do I avoid them? Could you please clarify? I'm not sure what you mean there. John Wick asking, would I agree with the notion that puts on SPY or SPX further out to expiration, say 5 to 6 months, might be a solid play due to the worsening of macroeconomic factors and the constant refinancing through debt in a low interest environment, while now entering one of the highest interest rate environments in the last 2 decades? Not really. And part of the reason why is, one, implied volatility going into January may increase, right? So if you're long a put and implied volatility increases, the value of that put also goes up. But you have to take into account the theta burn against that put. So if theta burns value away faster than an increase in implied volatility adds value, then you still lose money on the trade holding it. You could probably try to profit off of the delta change, the change in underlying SPY or S&P 500 index. But it's unclear to what extent the Fed will try to intervene versus just let the market fall. And that's, I think, what's currently priced in to medium or long-term SPY options contracts. So if you're of the opinion that within the next 5 to 6 months, SPY will decrease faster than what the current volatility is projecting, then by all means, buy that put contract. Go for it. I'm of the opinion we need a stronger catalyst. Then this doesn't feel good for now. Broadly speaking, I agree we're approaching a recession. I couldn't tell you when precisely it'll happen. Lost my 2A asking, Buffett made comments about market consistently overvaluing long-dated cash-secured puts being consistently partially due to Black-Scholes not factoring in inflation. So based on this, do you think selling LEAP puts in period of high implied volatility could be very safe and profitable? Generally speaking, high implied volatility also means high risk of downside. So as long as your LEAPs are far enough out of the money, at a low enough delta that you're willing to take on that risk, then yes, it's profitable and potentially safe. Just a quick reminder, think of delta as the probability that the stock or that the options contract will be in the money between now and expiration. So a delta of 0.5 implies a 50% chance that this contract will be in the money at expiration. A delta of 0.5 implies a 5% chance that the contract will be in the money between now and expiration. And keep in mind, these are market implied probabilities. So if you think the probability is different, you can take advantage of that difference, and if you're correct, be rewarded for it. Amitachi asking, what is the market impact of Japan buying these bonds recently? So at the moment, there is relatively little demand for the Japanese yen, which is causing it to lose value. The Japanese central bank, or the central bank equivalent, has basically been forcing forcing borrowers to pay back some of their loans, some of those bonds early, in order to spur demand for yen, because the bonds that were borrowed in yen have to be paid back in yen. As for the market impact, one popular trade was something called the carry trade, where an institution would borrow in yen, convert that loan to dollars, use it to buy some asset that's paying the interest rate and then some. And then as the yen devalues, pay back that yen with the fewer dollars it requires to pay back the yen, and then keep the rest as profit. So this carry trade availability drying up implies that there's less capital available to invest elsewhere because there's no Japanese leverage being introduced, and therefore downsies on other markets. The only markets that are financed by Japanese debt. Unix Enjoyer asking, what's the best broker for trading options? On Fidelity, the price increment rules can sometimes cause me to either overbid or underbid. So, for example, if they want to buy at 18 cents, you can only do 15 cents or 20 cents. Or is universal for all brokers? If the liquidity is high enough, then it's possible for options contracts below, let's say, 30 cents a share to trade in 1 cent increments. If the liquidity is too low, then you'll be forced to trade in those 5 cent increments. It's a consequence of the exchanges, not really the brokers. Someone asking my opinion for puts on Apple. So let's have a look. So Apple, I'll put the link to the chart in the chat so you can follow along. So looking at Apple, the last, let's say from September 26th to present, whenever the price rises to delta neutral, it goes back down quickly, fairly quickly. And right now, Apple's price is below delta neutral. So you could probably try a mean reversion trade to buy, let's see, like a 130 strike or 132 strike maybe call on Apple for the next 3 weeks, 3 to 6 weeks, with the expectation that the price will come back to delta neutral. I personally would not be doing this, but if you really want to make the bet, that's what I would do. I would not explore puts on Apple until the price reaches 162 or thereabouts, and that may change as Gamma Max updates every day. And opinion, I gave you I invited you to speak and gave you the ability to host. You had mentioned there were other questions elsewhere. Saki Basil asking, where is Tesla going from here, more down or up? I'm of the opinion sideways, or maybe slightly up because dead cat bounce. CB Long Socks asking, how can I use the wheel strategy if I'm holding AT&T stock currently? So remember, the wheel, for those who don't know, you sell cash secured puts and realize the gain due to the premium gain due to the options expiring worthless until you are assigned the shares because the price went below your strike. At that point, if you have the shares, you can then sell covered calls at a strike above your acquisition price so that you can use the premiums of the covered calls to make your money back. So in this case, CB long stocks, I have no idea what you paid for, how much you paid for your AT&T stock. But if you sell covered calls for a strike price higher than the price you purchased your AT&T stock, then if your calls are exercised and the shares taken away from you, you at least turn a profit on those shares. And then you can just keep selling expiring call contracts, again secured by your AT&T stock collateral. Just keep in mind the how do I phrase this? Keep in mind that one option contract represents a 100 share block of shares. So make sure that you have sufficient blocks of shares to support your options trading. No Taste asking, is it my opinion that within the next year, recession of any level is guaranteed? And if so, how severe do I imagine it getting? I can't say it's guaranteed, and the biggest reason why is because the risk of intervention. Keep in mind, we're approaching an election year, or we're approaching the presidential election cycle. And it would be a little naive to think that neither party in the US will ignore the economy as a campaign platform. So it's entirely possible that over the course of trying to get elected, both parties will say they'll fix the economy or they'll introduce bills to kick the can down the road, which in which case would push recession to 2024. Now, in terms of severity, uh, the biggest catalyst that I'm paying attention to at the moment are layoffs. I'm of the opinion the layoffs in Q3 and Q4 were just the first wave. Uh, there will probably, now that new corporate budgets have been settled for 2023 at the close of 2022, the next wave of layoffs will probably be as bad, if not worse, as the initial wave. Now, when someone is laid off, sometimes they'll receive a severance and they'll have some savings, but they also still have their car payment, their mortgage, their food bill, all those expenses. And so, net of severance, I imagine the layoffs will carry them for a quarter, and then unemployment will carry them for another quarter, after which they start, after which they start falling behind on their mortgage, on their car payment. They start like cutting corners on their food bill, that sort of thing. So figure 2 quarters after a major wave of layoffs will mean a large amount of potential involuntary selling of homes. So, for example, people trying to get out of homes that they originally couldn't afford anyway start discounting them to ditch the home, give up their equity, but avoid foreclosure. And that's the scale of that is what will, I imagine, determine how big or how severe the impact of the recession will be. Of course, don't forget, government intervention is a real possibility. And I don't know how to quantify the impact of government intervention here, or the risk of government intervention. Let's see. Sabotage asking, what is a strategy when buying longer DTE or days to expiration contracts? So, for example, why would someone buy a 7 DTE or 30 DTE going into the purchase? How long are you planning on holding that contract in general? Should you only be buying 30 DTE contracts if you plan to hold for a few weeks or longer? So, it depends on the nature of the event that you're trading. Uh, as a quick example, I trade very occasionally 0 DTE contracts whenever there's an intraday market event, typically FOMC announcements, because I want to minimize my exposure to theta, but maximize my exposure to delta, or the change in the underlying price because of the news. You could say the same for any set of expiration. So if I were to buy, let's say, a leap, right? So let's say a 300-day expiration leap, roughly roughly 1 year. my expectation is that the price of the stock will go up faster than the value of the leap goes down. I don't know specifically what catalyst would do it, but that's a good way to leverage, for example, uh, medium-term deep value plays. And then if you plan to hold a few weeks or longer, keep in mind the slope of theta. So as time passes, the theta component starts to accelerate. And sometimes it's worth, supposing you have an event that's 20 days in the future, to buy a contract that expires 60 days in the future so that you don't deal with the acceleration of theta as much as you would have. And then the slope of theta varies a lot by contract, by stock. So you'd need to get a sense of at what days to expiration the slope starts to accelerate, and then you use that inflection point of acceleration as your target date for whatever event you hope will make the option rocket in value. The goat asking, they're a forex trader and been trading for 5 years, profitable for the last 2, making 8K a month. Congrats. How can you invest and build yourself a background investment or a long-term thing to hold and make money, or a retirement plan? So generally speaking, I try to spin off profits into some sort of cash flowing investment. What I like to do nowadays is after I have a big windfall in the options in the markets, I'll usually take a third of that money and buy a website, some sort of website that has a strong amount of traffic from SEO or so other sources, and generates ad revenue. So I can earn a reasonable 15 to 20% a year on that invested cash. The downside, of course, is I do have a staff of people who maintain the websites for me, and their job pretty much is to grow those websites. So, one hypothetical example, I could buy a website earning $1,000 a month for $30,000 with my team, increase the website's revenue so that it's earning $2,000 a month, and then resell that website for the same multiple. So effectively get $60,000 for that website. And that's a separate discussion, but that's where I make, for now, the bulk of my money. Dizzy Clan asking, how many pounds of pure coke do you need to sell to create enough leverage to beat the options market? About 350. Mike Smuggler, what tools do you suggest using to look at options and estimate fair option prices with margins for success? At a minimum, I would suggest looking at a level 2 screen. So a level 2 screen shows you not just the price, but also the quantity of contracts or shares available at that price. And that way, if you want to buy more than the front number, so let's say the first level of the order of a level 2 book is 10 contracts, you want to buy 100 contracts, you can go down the order book to see what your average purchase price will be if you wanted to market buy 100 contracts. And then knowing, as you explore the level 2 order book, you can get a sense of where the important price levels are, because that's where the highest volume of buyers or sellers is. And you can use that to place your trades based on, in reaction to what the rest of the market thinks is fair value. And then beyond that, learn how binomial option pricing works, or Black-Scholes, or any other pricing models from academic papers. Those tend to be more up to date than textbooks. Some phone number is asking me thoughts on selling or holding Acer. I don't know if that's the ticker, or I guess it's a ticker. You bought 5,000 at $1.88 a share. So it peaked at like 450. I'm of the opinion that you should always, especially for speculative penny stocks like this, you should always sell half on a double so that the remaining half is free rolled and you can afford for it to go to zero. And that way, much less stress. The Churb asking, do I believe buying SQQQ and Yang stocks, not options, at these prices is ideal? Yang, yes. SQQQ, no. So if you're Yang, I'm intentionally selling cash secured puts so that I can build. I'm paid to buy at certain prices so that I can build a position in Yang because I'm of the opinion there will be a post Chinese New Year lockdown of some sort. As for SQQQ, SQQQ is at a relative high, so I wouldn't start buying SQQQ until it falls back down toward like 32 or maybe even $30 a share. So I'm happy to sell cash secured puts down in those levels. Someone asking my opinion on SH. Yeah, you can trade it if you want. I don't normally do 1x ETFs. Leverage ETFs are more my jam. Boozy asking if I am buying or holding SQQQ or Yang calls out to Q2 and beyond or further out. I'm not. So at the moment, I'm not buying calls. I am selling puts against them because I expect slightly bearish to neutral movement on both. I will switch to buying calls when there is a potential catalyst that would cause a huge market move. Think lockdown. Well, not maybe not lockdown level, but 70% the impact of the lockdown level we saw back in 2021. John Wick following up. They bought the SPY and SPX puts in the first days of December. IV was lower than expected. IV in January, therefore, shouldn't there be any possible profits coming if the market's going to crash? Yes, there is, but I believe a good chunk of that is already priced in. So you would need another catalyst to cause the market expectation to move down in order for your puts to turn a profit or turn a larger profit. So Ryler asking bullish on healthcare sector overall going into 2023. Okay, fine. Would it make sense to just hold shares of XLV or long OTM calls? So let's see what XLV. Well, first of all, you need to know which companies are included in XLV. And assuming that you're comfortable with these companies representing the healthcare sector, like United Health Group, Johnson & Johnson, Eli Lilly, AbbVie, Pfizer, etc., then if you were to buy long out the money calls, you need to calculate how much your theta cost is at different points in time and see how that theta cost measures against your expected growth trajectory for the healthcare sector. So you could let's see, XLV, maybe IV is low enough it doesn't matter. So if we look at January 2024 XLV calls, you're spending about 10% premium, $12 to $13 to buy at the money calls, so 136 strike. So the price of the healthcare sector needs to go up 10% in order for you to break even. If you think that'll happen, then buy the calls. If you don't think that'll happen, you could probably sell the calls and buy shares to act as collateral and hedge your risk. All right. Responsible Bug, I saw you raised your hand. See if we can bring you up if you wanted to ask your question live. In the meantime, Pleasant Anomaly asking, do I follow super investors, hedge funds, buying, selling news? I do not. I look at filings only. If someone announces in the news that they bought or sold something, they could just as easily be lying. But the filings, they're not supposed to lie. As for insider trading news, I just used the 13F filings because that's usually where they get it from anyway. Seven Smokes asking, generally regarded as overvalued, gig economy stocks like Airbnb, which has lost any type of support, when and what type of put strategy would you use to capitalize? So, if you and the rest of the market think the stock is going down, the price of the puts will already be inflated to reflect that. A good way to think about it is, let's say your 1 year outlook on Airbnb is bearish, right? So if we look at the January 2024 put, at the money put on Airbnb, the market is currently expecting, or currently pricing, charging what, 16.70? Let's call it $17. To buy a put 1 year out on the $85 strike. So basically, the price needs to go down lower than what is that, $68 by January 2024 in order for your long put contract to turn a profit. If you think that's true and you think the Airbnb will go well below that price over the next year, then by all means, go for it. Buy the put. If you don't, exercise caution because this is what the market thinks. Thoughts on some cursed bank asking thoughts on TQQQ. Yes, I have them. What specifically did you want to know about TQQQ? Brenlal's asking thoughts on cobalt mining stocks. Could you perhaps list a few? My cobalt, for those who don't know, is the next major or another major component or element that goes into making lithium batteries. I believe the other one is nickel. And cobalt is not necessarily a green, and I use the term very loosely, a green or environmentally friendly mineral to mine. There are battery technologies out there that are cobalt free, and it's unclear to what extent those cobalt free batteries can saturate the market faster than these cobalt mining stocks can turn a profit. Initial thought asking, in general, do I want to lower theta than delta on an options contract? If I'm buying the options contract, I want to minimize my theta impact and maximize my delta impact, assuming my thesis is the stock price will move up. So in that case, yes, I would want a lower theta than delta. If I'm selling an options contract, I want the reverse to be true. I want to maximize my theta gain, minimize my delta exposure. Guda asking, how do I purchase websites? What are the prices? Can I explain more? That's probably for another time, but very briefly, the website market is basically you buy and sell based on a multiple of monthly revenue. So if monthly revenue is 100 and the multiple is 30, you're spending, that website will cost you $3,000. I treat it like old style PE funds that would use debt to take a company private, improve the company so that it's generating a higher cash flow or higher profit, and then re-IPO it at the same multiple but a higher price because it has higher profit. So same concept for these websites, but a little outside the scope of options. God save all extra Beck. Unity News? I don't know what you're asking here. Fatal Clutch. If I buy a longer expiration date call, Do I go for a higher strike price or a strike price that's closest to the current price out the money? It depends. So, for example, one of my long-held theses is the GameStop January 2020 237.50 calls. I held those since pre-split, incidentally. So at one point it was a longer expiration date, but I went for the highest strike price available. And the reason why is because I was trading the Vega, or the change in Vega. No, sorry, the change in implied volatility. And with the expectation that whenever GameStop had a massive run, the implied volatility from irrational buying went to the moon. And so I was able to make money off of these extremely out the money calls without the price ever getting near to in the money. Jefferson's hat asking if I were to target mortgage originators and services for puts with the assumption of recession and continued increasing rates, what would be the company's tickers? Rocket, I believe, is a mortgage originator, so ticker RKT, and I believe their competitor is UWMC, the other mortgage originating company. And let's see, who are trust banks? Bank of New York Mellon is a major trust bank. So I have no idea if they're even publicly traded. If they are, then that would be a good target. All right, let's see. All right, so this last batch of questions, and I think we'll call it a day. So Boozy asking, in determining how a stock will react off of gamma max and delta neutral, do you have a minimum number of data points in support of the predicted reaction, and do they have to occur within a maximum time range? Not at all. So up until last summer, for example, Blackstone would take anywhere from 3 to 5 months to finish one cycle of a bounce off delta neutral. Didn't matter because we made money anyway. What's more important is seeing if there's a consistent pattern. So, for example, if a stock will bounce off of delta neutral and then go away for delta neutral for 2 weeks and then come back over 3 weeks, then I want to make sure I price the options so that I capture that 2-week run. Does that make sense? Same for bouncing off gamma max. So if it's only like a 3-day bounce, then I'll only buy an options contract that takes advantage of that 3-day bounce. And I also use simple Bayesian statistics to get a sense of the expected distribution of returns. So let's say in the past, for a given stock, the past 3 downward crosses of delta neutral produced a 2%, a 4%, and a 3% move. Then I would average that out to 3% and then calculate the standard deviation on that, which is like 1 and change. So I would expect the move to be between 1.5 and 5%, let's say, hypothetically. And so I would price the option contract to profit within that expected range. And I try, well, ideally I try to double within the lower end of that range. And if I can, great. If I can't, that's also okay. I'll exit early. Bablu Mango asking, do I still post Delta Gamma plays and or will I get back to those? Yes, I do intend to post them next year. I haven't been posting for the last 2 weeks mainly because Santa Claus rally plus tax loss harvesting made the market too turbulent for these patterns to really make sense. So it wasn't worth putting out plays to cause people to lose money. Own Tackle asking, best place to check unusual option activity? No idea. I don't really check that. but I believe Unusual Whales, Swaggy Stock, like all the secondary data providers have produced their own unusual options activity product in some way. And Cursed Bank asking, what are my thoughts on how TQQQ will be moving going into January? So, hard to say because I'm not entirely sure how much of the tax loss harvesting buying will occur in January versus in February. So, my guess is January will be relatively sideways for TQQQ. And with that, that's the time we have for today. Congratulations on another year of trading, everybody. And thank you very much for taking the time to ask your questions. If you have any more questions, by all means, feel free to post in this thread here on Reddit or reach out. Um, I'm happy to answer most of them. All right. Take care and Happy New Year, everyone. Enjoy your week.